Independent emerging markets commentator Geoffrey Dennis joins us right now on the phone line for his thoughts as well. And Jeff, not too much of a surprise, but what stood out? Actually, let me ask you what stood out for you first, within the commentary or the action.
A couple of things stood out for me. First of all, the commitment of the Fed to get inflation back to 2% was a bit more firm this time, and I think that's important. And also a slight change of emphasis on the consumption growth in the economy, downgrading that in the statement from strong to moderate. And that suggests to me that the Fed is a little bit more concerned than they were about the strength of the overall economy. And I think, therefore, the surprising market reaction was the fact that you ended up with a much stronger bond market. So the lower bond yields reflect those two factors. I mean, obviously, the lack of any interest rate change was as anticipated, but I think those two factors in the statement were rather important.
Yes, indeed. Two things, Jeff. One, this 2% inflation number and the emphasis they laid out by Jerome Powell. And again, since you spoke about it, just part two of that comment, that while they spoke about growth in whichever way they did, it almost seemed that as of now, these projections or these comments don't bake in any kind of potential impact from the coronavirus. They mention that it could have an impact, but not quite quantifying or giving some serious attention as of now. Could that worsen this outlook given by the Fed, so to say?
Oh, yes, no question at all. I mean, I think they're doing the right thing, frankly, not to build anything in here, because we just don't know. It's still such early days to really know what the impact of the virus is going to be. And of course, the first impact of the virus is going to be, in terms of macro, is going to be on the Chinese economy. And there's no doubt that if you were to see a significant hit to the Chinese economy, I mean, in 2003, the general opinion that everybody has now is that GDP growth in 2003 was impacted by about 0.8% of GDP from the SARS virus. And if you've got anything like that from Chinese growth, which is already way lower than it was in 2003, around 6%. Now, that would be a very big impact on the global economy, and that would have its own spin-off effect on the U.S. economy. So I think that they're waiting, the Fed's going to wait to see two things. Number one, what impact does it have on the Chinese economy and the indirect effect that has on the U.S.? And secondly, are there going to be enough cases in the U.S. to damage the U.S. economy itself? And I think at this point it's way early to think that's the case. But frankly, it is, of course, a negative risk. And in a sense, Powell is reserving judgment on this at this point because it's so early.
The one change, Jeff, that I thought was that the decision of the Fed was near unanimous, wasn't it? I mean, the last time around or the last year, we had a number of people at opposing ends. This time around, there's no dissent, so to say.
Yes, I think that's right. And I think what that probably means also, with the uncertainty at the margin over consumer spending, perhaps, increasing a bit, and obviously with the coronavirus as well and the potential that could impact that could have on growth, I think it means that the Fed is leaning a little bit towards eventually perhaps the next move being a rate cut as opposed to being a rate hike. And I think perhaps you got more of a consensus on the committee, moving a little bit in that sort of dovish direction. I think it's way too early. But it's fascinating to me that what you've seen here is a tremendous rally again in bonds over the last few weeks, taking us pretty much the lows of last October. And if this continues, or even if yields stay at this level around 155, 160 for the 10-year, people are going to start to say the Fed's going to cut rates anyway to avoid an inverted yield curve. And so I think, there's consensus that they haven't do anything now, and perhaps consensus on the committee about that. But I think, if anything, we're leaning towards more rate cuts down the road from what we know of what is going on in markets today and in the global economy.